Investment term for the day. Preferred stock. The term stock refers to ownership or equity in a firm. There are two types of equity: common stock and preferred stock. Preferred stockholders have a higher claim to dividends or assets distribution than common stockholders. The details of each preferred stock depend on the issue. Preferred shareholders have priority over common stockholders when it comes to dividends, which generally yield more than common stock and can be paid monthly or quarterly. These dividends can be fixed or set in terms of a benchmark interest rate, like the London Interbank Offered Rate, and are often quoted as a percentage in the issuing description. Adjustable rate shares specify certain factors that influence the dividend yield, and participating shares can pay additional dividends that are reckoned in terms of common stock dividends or the company's profit. The decision to pay the dividend is at the discretion of a company's board of directors. Unlike common stockholders, preferred stockholders have limited rights, which usually does not include voting. Preferred stock combines features of debt in that it pays fixed dividends, and equity in that it has the potential to appreciate in price, and this appeals to investors seeking stability in potential future cash flows. If a company is struggling and has to suspend its dividend, preferred shareholders may have the right to receive payment in arrears before the dividend can be resumed for common shareholders. Shares that have this arrangement are known as cumulative. If a company has multiple simultaneous issues of preferred stock, these may in turn be ranked in terms of priority. The highest ranking is called prior, followed by first preference, second preference, etc. Preferred shareholders have a prior claim on the company's assets if it is liquidated. Though they remain subordinate to bondholders, preferred shares are equity bought in many ways. They are hybrid assets that lie between stock and bonds. They offer more predictable income than common stock and are rated by the major credit rating agencies. Unlike with bondholders, failing to pay dividends to preferred shareholders does not mean a company is in default, because preferred shareholders do not enjoy the same guarantees as creditors. The ratings on preferred shares are generally lower than the same issuer's bond, with the yields being accordingly higher. And that was your investment term for the day.